if you thought about it, you say, well, gee, why doesn't China just, announce what they're doing and, bid up the price of gold and make a lot of money? Well, the answer is they're not done buying.
Exactly.
See, if you were buying, you wouldn't want the price to go up until you have all you want. When you have enough, that's different. But if you're still a buyer, you want the price to be moderate. So what's going on is a great game involving the major powers, involving gold. There's more to it, but that's what's driving the price higher.
According to the Central Bank of Russia, Russia's gold reserves reached an all-time high of $217.4 billion in February. This marks a significant milestone, with gold now accounting for more than one-third of the country's total reserves for the first time since the 20th century. Despite facing Western financial sanctions and freezing $300 billion in assets, Russia's strategic accumulation of gold has helped mitigate economic pressures. Rising gold prices, partly fueled by these sanctions, have increased the value of the country's holdings, reinforcing gold's role as a hedge against financial instability. In January, the Bank of Russia and the Central Bank of Jordan were the leading sellers of gold among central banks, each offloading 3 tons, while the National Bank of Kyrgyzstan also ranked among the top sellers, according to the World Gold Council. China, meanwhile, continues to expand its gold reserves, increasing its holdings to 73.61 million fine troy ounces at the end of February, up from 73.45 million in January. The total value of China's gold reserves rose to $208.64 billion, reflecting ongoing accumulation by the People's Bank of China for a 4th consecutive month. Rickards highlights that China has strategically bolstered its gold stockpile, often acquiring the metal through sovereign wealth funds rather than direct central bank purchases. This discreet approach helps maintain demand without signaling its entire strategy to the market, allowing for continued accumulation at favorable prices before any significant price revaluation occurs. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Retail is a little more active, you're right about that, but they're not really driving the market. In a panic, they will, but it'll be too late. I mean, it'll be, I was saying buy gold at 700, 1,300, 1,900, 2,000. It's now close to 3,000. People just don't do it. It's fine. I'm not in charge of their finances, but people just don't do it. The funny thing is, Danielle, this is just human nature. When it spikes to 4,000 or 5,000, then they'll run out and buy it. They could have had it at 1,300, but they'll wait until it spikes. That's just human nature. The big buyers are the central banks. They're the players. Some institutions, some hedge funds, but mainly the central banks, and we know who they are. It's Russia and China, but also Vietnam is a big buyer. I mentioned their trade surplus earlier. Okay, what are they doing with the money? Well, one of the things they're doing is buying gold. Kazakhstan, Turkey, Iran's buying it. They're non-transparent, but they're buying it, and Mexico and many others. So the central banks are driving. The inflection point was 2010. From 1970 to 2010, central banks were net sellers, but since 2010, they've been net buyers, but the amount of buying has been going up. I mean, Russia has increased their gold reserves by 5 times. In 2009, they were 600 tons. Today, they're about 3,000 tons. That's a 5 times increase in, it's 16 years, but that's still 500% more gold. By the way, that gold has saved them in the Ukrainian war because the U.S. put financial sanctions and tried to steal $300 billion of U.S. Treasury securities that Russia paid for with dollars that they made by selling oil. When we froze the U.S. Treasury securities, and now we're in the process of stealing them, they stole $50 billion out of the $300 billion to make a loan to Ukraine. That's never going to get repaid. But Russia had put, Elvira Nabiullina, who's the head of the Central Bank of Russia, she had put 25% of their reserves in gold before the war in Ukraine, again, in this period since 2009. Now, here's one of the ironies that shows how much the U.S. doesn't understand about this. The war and the central bank buying and the kinds of things we've been talking about have driven up the price of gold so much that Russia has made $100 billion of profits on a mark-to-market basis on their gold. So, we froze $300 billion in Treasury securities, but they've been continuing to sell oil and natural gas, and they've made $100 billion on their gold, which thanks to us because we're the ones causing all the problems. So they're the driving force. Now, they have to be, Russia has been they've shown a lot of finesse in how they do it. They buy 10 tons a month, 20 tons a month. Some months they skip. Recently, they haven't reported anything. I don't think that means that they're not buying gold. I think it probably means they're buying the gold through the sovereign wealth fund instead of the central bank, which is what China does. China's been buying gold all along, but we don't really have hard data because they don't buy it through the central bank. They buy it through their sovereign wealth fund with something called SAFE, State Administration of Foreign Exchange. So they have these pockets where they can buy gold without putting it on the central bank balance sheet. But that's what's really driving the price of gold. And if you thought about it, you say, well, gee, why doesn't China just, announce what they're doing and, bid up the price of gold and make a lot of money? Well, the answer is they're not done buying.
Exactly.
See, if you were buying, you wouldn't want the price to go up until you have all you want. When you have enough, that's different. But if you're still a buyer, you want the price to be moderate. So what's going on is a great game involving the major powers, involving gold. There's more to it, but that's what's driving the price higher.
Gold prices remained firm as the US dollar hovered near a 4-month low, following a sharp decline in the previous session. The weakening dollar, which makes gold more attractive to investors by lowering its relative cost, helped push the metal toward a nearly 2% gain for the week. Recent shifts in U.S. trade policy have further fueled market uncertainty. Earlier this week, President Trump escalated trade tensions by imposing 25% tariffs on Canadian and Mexican goods, while raising Chinese tariffs to 20%. However, 2 days later, he softened his stance, delaying the 25% tariffs on Mexican and Canadian goods under the United States-Mexico-Canada Agreement until April 2nd. While this move offers temporary relief, it has added to overall market volatility and left investors uncertain about the future direction of U.S. trade policy. Gold, often viewed as a safe haven asset during economic and geopolitical instability, has remained well supported amid these developments. According to financial expert JimRickards, tariffs on gold, such as those introduced by the U.S., are unlikely to significantly impact global gold prices. Since gold, like oil, is a widely traded commodity with established markets in multiple regions, investors can easily shift their sourcing to avoid tariffs, ensuring that broader price trends remain unaffected. Let's get back to the interview.
Gold might be affected by the tariffs. It's like Trump put these tariffs on. They applied to everything. Now he's creating carve-outs, and as he said, the auto industry, they're getting a 30-day pause. But the tariffs are extremely broad, so they would apply to gold in the first instance, unless he carved it out, which he hasn't. Having said that, it won't have any effect on the global price of gold. The reason is that gold is kind of like oil, gold, a couple other things. These are global prices. They're produced all over the world, not everywhere, but in every part of the world. They're consumed in every part of the world, and they're easily substituted. So if the U.S. doesn't buy oil from Saudi Arabia, we don't buy that much from Saudi Arabia anyway. We can buy from Venezuela. If Canada cuts us off, we can buy more from Mexico or more from Venezuela. But the same is true of gold. The price is set in two places: the London bullion market and the COMEX, the New York commodities market. And physical prices and paper gold prices vary. There's a lot to it. But my point being, if there's a tariff on gold coming from Canada to the U.S., we'll just buy it in Shanghai, buy it from Africa, buy it from Switzerland. The point being, when a commodity is truly generic, a car is not generic. You get a certain brand and a certain set of features, and it's electric or hybrid or whatever. Cars are not generic. Gold is. It's an element, atomic number 79. So the point being, when you have a generic, fungible global commodity, tariffs don't affect the price, because if you're getting hit with a tariff, you just don't buy it from that source, you buy it from somewhere else. Now, getting back to your other point, Danielle, about shipments from gold, it does appear that there was some kind of short squeeze emerging, and that shorts were having trouble getting physical gold to satisfy deliveries. Now, that can only go so far. If you look at, say, how do you get short gold? You sell gold futures on the COMEX, 1 month, 2 months, 3 months forward, and then you get to the end of the contract, and the buyer says, "I would like physical delivery, please. I don't just want to pair off or roll over my contract. That's a paper transaction. That's the way most futures settle. But if someone long in the future says, I'd like to take delivery, please, then yeah, you got to look at the warehouse and see what's there. And if there's not enough, you might have to get it from London or some other source. Now, that appears to account for some of the deliveries and some of the urgency about that. Having said that, there's a limit on that, and you have to read the COMEX rule book. I'm enough of a geek. I actually have read the COMEX rule book, but there are two important rules. Number one, they have a rule that says they can change the rules. So if things get tight or things get disorderly, they can just say sorry. No more physical delivery. We're trading for liquidation only. You can pay off your contract, roll it over, but you can't take physical delivery. They can just say that. And it is what they did to the Hunt brothers in 1980, I believe, 80 or 81, when they tried to corner the silver market. But there's another principle, which is also in the rule book, but it's just more broadly stated. Futures exchanges say, all of them say, we are not a source of supply.
As global economic uncertainties persist, gold plays a crucial role as both a hedge against financial instability and a strategic asset for central banks. With rising reserves in key economies and shifting trade policies influencing market dynamics, the precious metal remains a focal point for investors seeking security amid volatility. As nations discreetly accumulate gold and adjust their holdings, the broader implications for currency markets and economic policies become increasingly significant. What impact do you think growing gold reserves will have on the global financial system in the long run? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.